Hello, my name is Pavel Konecny and I am the Chief Investment Officer at TriStar Trust. And I've been thinking the last couple of weeks, what should we do in these markets as investors? There's a lot of negative news out there that is pointing to us potentially entering recession, whether it's inflation, whether it's rising interest rates, whether it's the conflict in Russia and Ukraine, and a bunch of other measurements that point to a slowdown in the economy. So as an investor, what do you do during these times? Interestingly enough, a known hedge fund manager just came out and said this is not an attractive environment for investors, whether it's bonds or equity or stocks, and that preservation of capital is the answer. The challenge with that statement is he is a hedge fund manager, and for the most of us, we don't have the resources to try to time the market, and we have found that following emotions when investing is not healthy. And I have a couple of charts or a couple of data points that I would like to illustrate, because what you see is when people follow the herd, meaning they get excited when the markets go up, everybody is buying, so they wait and wait and wait, and eventually they start buying into the market, and they either are too late or they start buying at the peak of the market. Then of course every market goes through a cycle, and what happens is that markets start declining and now fear kicks in, and then an all-out panic happens when the market drops to, let's say, bear territory, and all of a sudden everybody's selling. So they're basically buying high and selling low. There's been a study done over a three-year period over the last 20 some years, and what's interesting is that the people who invest and follow the herd, they make about 5.5% during that time. However, people who buy when everybody is selling made about 15%, while the S&P 500 during the same period of time returns about 10. So following the herd is not healthy for investors. The other side of it is trying to time the market is also not healthy. Staying the course, especially when most of us have a long investment horizon, is probably the most important thing. Because if you try to get out of the market and you miss just 5 days of the best returns, the results are, I don't want to call it devastating, but it's a material result. Your $100,000 can turn to $400,000 if you miss 5 best days in the market returns. But if you actually stayed, that same $400,000 now equals over $600,000. So the point is that trying to time the market is really not the right thing to do. Staying the course and staying invested is important. If there are any funds available, reinvesting into this market is probably a wise thing, because considering what's going to happen with the United States and the global economy, and historically what we've seen, markets always recover, and you don't want to be left on the sidelines.